Hello and welcome to Market Domination Overtime. Stocks ending the week on a high note after a bruising tech sell-off this week, the Dow hitting a milestone. And let's kick it over to Yahoo Finance's Ines Ferre with the trading action. And Ines, 50,000, we did it in the Dow.
That's right, 50,000 in the Dow, up more than 2% for today, a record for the Dow. Look, I was on the floor of the stock exchange when we were going to 40,000, now 50,000. I mean, these are coming quicker and quicker, it seems. Over on the NASDAQ, up more than 2%, and the S&P 500 also about 2%. A sharp rebound is what we've been seeing, really, from this volatile week that we had. Taking under the hood at the sector action, we're going to pull up technology stocks, industrials, and materials, which are leading, which have led the gains today. Also, just taking a look at the 5-day chart so you can see some of the rotation that was going on this week into consumer staples, industrials, and materials, as we've seen that rotation throughout really January. Taking a look at the Dow, and you can see there the names that really led the Dow higher: NVIDIA, Walmart, JP Morgan, Amazon down more than 5%, but cutting its losses from earlier when we opened this morning. And over on the NASDAQ 100, you can see a mixed picture there for the Mag 7 with Meta and Alphabet that are lower, and Amazon, as I just mentioned. But take a look at Broadcom, up more than 7% for Broadcom. AMD, the semiconductors, tech really leading today. I do want to point out some of the software stocks that we saw earlier today. A little bit of a bounce there. Software really got hit this week. And what also got hit this week, which rebounded sharply today, is Bitcoin. Bitcoin up more than 10%, just making a $10,000 move per token over the last 24 hours, really, because you saw the lows at 61,000. Ethereum also up more than 10% for the session as well, just hovering above 2,000. So quite a big comeback for crypto, although some strategists are saying we may not have seen the low yet because we are in a downward trend for when it comes to crypto.
Wise words there, and we'll keep that in mind. Thank you, Ines, for that report. And a major snapback for markets on Friday. The Dow closing above 50,000 for the first time ever. Joining me now is Brad Conger, Hirtle Callaghan, Chief Investment Officer. Brad, thank you for joining here today. I'd love to get your hot take on the market action this week. So, we got some headlines about the Dow over 50,000, S&P 500 almost at a record high, but serious problems in tech, and they're not quite over yet, it seems.
Yeah, and it's also very dispersed and very distinct, sort of a repricing of expectations. So hyperscalers, if you think of them as the center of the ecosystem, are down on the week. All of their suppliers, basically semiconductors and power and storage and so forth, are up. And then the downstream clients of the hyperscalers, the software companies, application software, are down. So really, it's interesting that the market has started to question the long-term returns for the hyperscalers, basically selling compute and the investment of new capital, but it's not being reflected in the hardware suppliers into those businesses. They're counting the money as spent.
Well, if we could go to the Wi-Fi Interactive for a second, I want to make a point here. In January, we saw a huge surge in consumer staples, and here we have the year-to-date performance for the large cap sectors. Number one is energy, and then staples. I was just talking about that. That's up 13.2%. That's number three. Materials is a gold and silver story, arguably, and copper too. Then we got industrials. That's cyclical. But then we got real estate, healthcare, utilities, and then you're going to see down here those mega cap sectors. They're all in the red. So what do you make of this rotation out of those AI leaders and into some of the more defensive names, if not in the company of some of these more cyclical names as well?
So you can certainly think that what we're seeing is a change of leadership from AI technology into, I would say, real economy names, like you mentioned, the cyclicals, materials, oil, industrials. And that's been going on since about before Thanksgiving. Mm-hmm. And I think it suggests that people are de-risking their portfolios a little bit. They're taking out the highest beta names, and they are migrating into what they view as participants in overall economic growth with less bet on a technology marvel or revolution.
What do you think this says about the rest of 2026 then?
I think
Loaded question.
I think it's going to be very volatile because we have geopolitics at an extreme, an upcoming midterm. You've got a lot of uncertainty over the job market. We had a couple of pieces of data this week which suggested that the job market is slower than we thought, and therefore that makes it hard for the Fed to focus on inflation at all. We have a new Fed chair. So I would say the overarching theme for this year is going to be volatility, which puts a premium on being very comfortable with the names that you have and understanding that they're going to be down. For example, software holders figured out that their names are not invincible over the past month and a half, and they can lose money even in great companies. The only real impairment of value is when you sell due to something that is transient and give up real long-term value.
I want to go big picture now because I was reading your notes earlier and you've hit on something that I have to agree with. There's a lot of crowded thinking in the investment community, from portfolio managers to analysts, et cetera. Where do you think this goes from here? Because it didn't necessarily used to be this way. You had more contrarians, it seems to me, in the past.
Yeah, and the problem is that anybody who had a contrarian outlook or bias in their investing has tended to fade the things that have worked since 2013. And so to a large extent, the contrarians are out of business. They lost their capital. And the market voted with their feet in favor of people who are following trends and extrapolating, because extrapolation has worked. Companies have really increased the length, the duration, and the magnitude of their moat over the past 10 years. I think that all things come to an end, and I think when the constituency of the buyer base sort of coalesces around a received narrative, a kind of received wisdom, and become very comfortable, like we saw in software over the past since the start of the year, they do so, at their own hazard.
And here's another kind of big picture question that I think is relevant right now. Since the pandemic, I mean, you think about that March 20th pandemic sell-off and then rebound to all-time highs in a very short period of time. We saw that even quicker in last April. And it just seems like the investing public is now kind of conditioned to believe that these wipeouts, that they're just going to be short-lived. And what do you think that means? How does that play out when we have a longer downturn?
It's going to make so first of all, it makes the market more stable because people are convinced that there is a Trump put or a Fed put, Warsh put on the market, so that whenever when markets are dislocated, even temporarily, somebody from the administration comes out and makes a soothing remark, or the Fed indicates that they'll quit their QT and start QE again. But as you suggested, ultimately, reality will hit, and it makes the dawning of that reality much more painful.
I hear you there. It's been great chatting with you. Thanks for spending some time with us, Brad.
Thanks, Jared. Take care.
And turning now to the Fed, as Vice Chair Philip Jefferson shares a hawkish tone on interest rates, we have Yahoo Finance's Jennifer Schonberger now with the latest. What is the latest, Jen?
Hey there, Jared. Good to see you. Happy Friday. Yeah, we heard from Vice Chair of the Federal Reserve, Philip Jefferson, earlier today, who says that he sees the Fed's benchmark interest rate in the broad range of estimates for neutral. That's a level designed to neither spur nor slow economic growth. He says he's closely looking at the economic data for any additional rate cuts this year. Speaking earlier this afternoon at the Brookings Institution in Washington, Jefferson said, quote, "The current policy stance is well positioned to address the risks to both sides of our dual mandate." He went on to say our policy stance should help stabilize the labor market while allowing inflation to resume its decline toward our 2% target. Now, Jefferson painted a nice picture for the year ahead, raising his outlook for the economy on signs of resilience. He now sees GDP in the range of 2.2%, which is about in line with what we saw last year. Though he noted that inflation has stalled over the past year on account of tariffs, he expects inflation to resume dropping once tariffs have worked their way through goods prices. Now, when it comes to the job market, he sees signs of stabilization. And while he cautioned that he still sees some downside risks to growth there, he thinks the unemployment rate is going to hold approximately steady in the range of where it is right now at 4.4%. Now, elsewhere today, we also heard from San Francisco Fed President Mary Daly, who posted on LinkedIn that she still has concerns about the strength of the job market. She noted that the low hire, low fire environment could persist, but then added that she knows workers are aware that things could change quickly, leaving them in what she called the no hiring, more firing labor market. Daly saying, quote, with inflation printing above the Fed's 2% goal, this rightly feels precarious. Jared, I'm sort of inferring there that Daly has some concerns about the job market. Perhaps she sees some more room to cut there. Back to you.
And one more question here, stick with me. What about concerns over Kevin Warsh? I know we got a heavy Fed calendar next week in terms of speeches, but have we heard anything on that front this week?
I'm so glad you asked that because the economics department at Duke University just did a survey of former Fed officials and former Fed staffers and found that 2/3 actually support Warsh's nomination. They say that he's got great institutional knowledge. They acknowledge that, he was there during the 2008 financial crisis. Though some did express some concern about Warsh's past criticism of central bank policies, while others argued that Warsh was mistaken on key policy issues when he was a Fed governor. As for his loyalties to President Trump when he is confirmed for Fed chair, if and when, responders unsure about that point. Jared.
Yeah, and I believe he was the youngest Fed governor, at least at the time, over the financial crisis in 2008. All right, thank you for that report, Jen.
Thanks so much, Jared.
And coming up, the big business of Super Bowl betting, the CEO of DraftKings joins me next. We are close to one of the biggest betting events of the year. Analysts estimating $1.7 billion being wagered on the Super Bowl this weekend. But it's also highlighting a new competitive dynamic. Alongside traditional sports books, prediction markets are gaining attention. And for more, we're bringing in Jason Robbins, co-founder and CEO of DraftKings. Great to have you here. Thank you. So big weekend.
Thanks for joining.
Yeah, big weekend for you. How big is it? How important is it to your business? And then what's important about it? Is it about the revenue that it brings in directly or immediately? Or is it about customer acquisition? Just kind of break it down for us.
Really all of the above. I'd say first and foremost, customer engagement, customer acquisition. This is the period where, or the game, I should say, that we get the most active customers participating. So maximizing that number and having as many of our customers engaged is the goal. And then obviously we'd love to do well from a revenue perspective too. That can be dependent on game outcomes, which can vary. So we don't get too caught up in that. But it would be nice if we had a good revenue day as well.
And I'm personally curious, given history, what actually makes a better revenue mix for you? Is it a game that's high scoring and very close? Or is it when the spread between the winner and the loser is greater? What makes for a great game for you guys on the books?
Low scoring, low yardage totals typically are good for us. It's interesting because the first couple of Super Bowls, who won the game really mattered. And that was the key determinant, or at least who covered the spread in terms of whether we did well. And there's been so much of a shift towards parlays, same game parlays and player props that now that almost doesn't matter. I mean, you could still have situations where it's skewed heavily, but for the most part, we don't really have a huge difference based on who wins the game. If you're betting on the Seahawks, you're probably parlaying that with Darnold and Jackson Smith and Jigba. You're betting on the Patriots, you're probably parlaying that with Drake May, maybe Stephon Diggs, Travion Henderson. So those are things where if you end up, having one of those teams win, but those players don't score, have a lot of yards, it blows up a lot of parlays. And so it almost doesn't matter who wins anymore. High scoring games, though, typically not great for us. Low scoring, low yardage games are typically good revenue wise. But more importantly, we want all our customers to have fun. So we don't get too caught up in any individual game outcome. Obviously, this is a big one, but overall, it all evens out over time.
And I mentioned in the intro prediction markets, they've had a lot of steam over the last few years. How has that affected your business, and are you leaning into that in any way?
Yeah, we launched DraftKings Predictions in December. We actually just announced and have just launched, or added, I should say, Crypto.com to our platform, which I'm really excited about. That adds a ton of additional content for us, things for people to trade on for the Super Bowl. So just in time for the biggest weekend of the year, we did that. We're very proud to be partnering with them and also with CME. So great, set of initial partners, and we're just going to keep building out the product. And I think keep trying to, create the best experience. It's still so early. We're less than 2 months into this thing. And, in the past, we've really shown that we have a great track record when it comes to rapidly developing product. I think right now we have the best product in all of online sports betting, and we're going to intend to do that in predictions too.
And what's the regulatory environment for you like right now? I remember covering this beat in 2017, 18, 19. It was really about getting things through the various states. What is it like now, and how are you dealing with the federal and state levels?
Well, it's a really interesting time from that perspective. You have obviously this, federal framework around predictions, and states in certain cases are challenging that. We'll see how that plays out through the court systems. As always, we are doing everything in a legal and regulatory compliant manner. We are ensuring that we have really open, transparent conversations with our regulators. I do believe we have great relationships there and have shown a lot of respect, and I think they appreciate that. And we're just trying to do things the right way. Obviously, it's always tricky when there's twists and turns in the environment, but I think if we continue to do things in the way we've been doing them, then we're going to end up positioning ourselves very well from that perspective.
And I believe you've hinted that the best opportunity for prediction-style products may be in places without legal online sports betting. So is there a strategy there that you might be pursuing?
Well, that's where we're focused now. We actually aren't offering these products, or at least sports products, in states that we have legal online sports betting in. So, we believe that that's a good sort of match between where the consumer opportunity, the demand is, and also where we think the right choice for DraftKings as it relates to our business and our existing relationships with regulators. So that's where we're focused now, and I think that's where the big opportunity is. So it's always nice when the big opportunity also aligns with where there's less risk. That said, we'll have to see how this all evolves. Obviously, there's court cases and other things that are happening. I saw the recent comments from Chairman Selig, which indicated that he is going to issue clear guidelines and rules of the road for this, which I think are great. I think that's going to help create an even playing field, and also make sure that things like integrity of the game are being upheld and managed in the right way. So really feel like that was a constructive set of comments, and looking forward to seeing how this evolves. And like always, we'll be there ready to capitalize on the opportunity.
And the lead here is the Super Bowl. It's a huge marquee event. How important are these for you versus the day-to-day when you just have regular games going on? How does that mix look like for your business?
Every day matters, but this isn't just the Super Bowl, it's our Super Bowl too. So we do have a very big day planned. We have a lot of great marketing going. We have a lot of great product and promotions going. It's really the thing that people all season long, our company, are gearing up for. But we also recognize that sports are fluid. As soon as the Super Bowl is over, people are on to the next thing. Pretty soon it'll be about March Madness. So sports moves quickly. We like to say we move at the speed of sports. We're hyper-focused on the Super Bowl right now, but we'll also be ready to go the next day with some great content for various sports that are playing.
All right, we got under a minute here, so I'll give you the floor. Anything you want to tell the viewers?
Well, like I said, I think I'm very excited about predictions, and it's a little bit frustrating, obviously, when the market hasn't caught on yet, but we got to prove that, and we will. But I think it's a huge opportunity for us. It's something that we really feel sets up well, where we are competitively positioned between our pricing models, our marketing know-how, our brand, and how strong it is in sports, our partnerships and national advertising footprint. So we feel like we're in as great a position as anybody, and hopefully we'll prove that out, and we'll start to get a little credit for it.
All right, good luck to you this weekend. Thank you, Jason.
Thank you.
Time now for What to Watch. The biggest football game of the year is taking place on Sunday when the Patriots and Seahawks go head-to-head in the Super Bowl. On the earnings front, another massive week. Crypto staples Robinhood and Coinbase are reporting. Pharma giants AstraZeneca and Moderna also posting earnings. And investor appetite is turning to the food and beverage space, with McDonald's announcing fourth quarter results on Wednesday. Analysts watching U.S. same-store sales and expecting a boost from value offerings like the Extra Value Meal and the Monopoly promotion. And to wash it all down, we have Coca-Cola earnings on Tuesday. Analysts expecting steady organic revenue growth driven by price and product mix. Investors will be listening close for any commentary around refranchising plans and ongoing IRS litigation. On the economic calendar, the delayed January jobs report is coming out on Wednesday, offering a fresh read on the labor market. Economists forecasting the U.S. economy to add 70,000 jobs, coming off a disappointing week of labor data. Then the focus shifts to inflation, with the Consumer Price Index coming out on Friday, a key test for the broader economic outlook and Fed policy in 2026. And speaking of the Fed, multiple Federal Reserve officials are speaking throughout the week, giving markets more clues on how policymakers are weighing all the economic data and the path forward for interest rates. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow or Monday at 3 p.m. Eastern for all your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.